All right, all right. I got you guys. Okay, well, anyways, I want to start this out by saying something that I always start out saying in these webinars. There is no dress rehearsals when it comes to trading. You're putting your own money on the line. And what I've learned from the Pitbull is that his best trades were not necessarily winning trades, but he'll get into that on his own. A couple quick slides here. This webinar has been dedicated to Charlie D. Francisca. And Charlie D. was a really well-known bond trader on the Board of Trade floor that believed in sharing his knowledge was his obligation or his duty to the markets or into the other locals around him. And as the Pitbull is going to be doing today, he's going to be sharing some of his ideas and thoughts. And to me, that's at the center of trading. If you want to be selfishy, if you want to sit around, you don't want to share your thoughts. Those thoughts will disappear eventually. And what we're here to do today is talk about some of the things that we think work. And really, like I said, the Pitbull is going to be unplugged. So Marty, I want to let you take over here. One last slide. It's the Charlie D. book. And we'll come back to these slides in a little bit. And then we've got the slide for Marty, the Pitbull. And if you read this is an excerpt from the Market Wizards book that talks about Marty's entering into these different Norm Zeta trading contests. And it's just an amazing thing what he's done as an individual trader. And to tell you the truth, as I've said many times, I've worked with some of the largest traders in the world, and Marty's one of them. Marty is one of them. He is it. Anyways, I'm going to turn it over to Marty, and I'm going to turn my headset off. And here you go, Marty.
Do Q&A at some point, but I'd rather we just banter back and forth, Danny. I met Danny in the...
Turn your headset around.
Guess I was going to the wrong side of the tracks. I met Danny in the late 80s, and we started out, I was trading S&Ps on the telephone, and he was in Chicago, and he asked me, well, what do I want him to do for me? And I said, well, just follow those who win and let me know what they're doing, just watch what they're doing. And he utilized his street smarts to kind of give me info from the pit. That was very helpful to me. But as things have evolved through a long period of time, things have changed as electronic trading came to bear and the computerization of the markets transpired. I have had an evolution in my career. I started trading the S&P futures in '82 when they first came into being, 1982 that is, and I then progressed through a period of time, and I've had my ups and downs doing it, and I've evolved using a lot of options and stocks as well as using S&P futures. In the early 2000s, I went and traded the oil market for 9 years, traded an awful lot of options. And at the end of 2013, I decided it was time to return to the S&Ps. And since then, I've been trading a great deal of S&P options. In that sense, I like to be the bookmaker. I sell a lot of option premium as I've built my capital up. And that's allowed me to have a great opportunity in doing that. There have been statistics through the years that 90 to 95% of the options expire worthless. So I root very hard for them to go to zero. I don't know what you want to do, Danny. You want to throw me some questions?
I'm going to jump in a little bit here, guys. And I want to kind of go back to. Can you guys hear me? Okay, cool. I kind of want to go back to what Marty was talking about back in the beginning. When I first met Marty, he had a clerk on the trading floor. Her name was Debbie, And Debbie's desk sat right next to, okay, let me see if I can control that. Hold on. Okay, is that better? That should be good. But anyways, when I first met Marty on the floor, he had a girl working for him that sat right next to the Salomon Brothers desk. If anybody remembers who Salomon was, they are Plaza on the trading floor, and they always seemed to have the news before anybody else had it. And I had this big desk, and Marty was trading away with the girl that worked for him, Debbie. And one day Debbie came up to the floor. We were doing the business. I think we were doing Sheikh Mohammed's business we were doing King Fahd's business, and King Fahd kept buying and selling these 3,000 lot orders in the S&P, and they were so noticeable. And one day Debbie came over to my desk and said she'd like me to call this guy Marty. And I no swipe at Marty. I had never met him before, so I didn't call him right away. And then a couple days later, she came back to the desk and she said, "Listen, will you please call him? He wants to talk to you." So I finally got around to the call, and Marty said something to me like, and we had just met. I thought it was one of the, it was very straightforward, and he was very honest about what he wanted. But he said, "Look, if you're not going to pick up the phone and return my calls, you can't do my business." And from that day on, I knew exactly what he was talking about. Listen, if you want to communicate with me, you get online and you start talking. So I started doing the business, and Marty had he just was amazing at picking levels. And every day Marty would call me with what he would call his channel lines. And we would trade off these channel lines. But back then you were only trying to make what? How much a day, Marty? He was trying to make 10 grand a day. And after the S&P, back around that time, I think he even talked about taking out an ad in the Wall Street Journal about condemning program trading back then. So he was way, way ahead of the curve on this stuff. And again, I'm going to let him talk because I don't want to be doing all this. But at one point, program trading continued to take up more volume of the S&P, and it just became harder to trade. And what trades he would be looking at, he'd call me up and say, "Listen, if the S&P gets down to 645 even."
Well, let me interrupt you. In those days, the program trades were sent by paper orders. And I noticed a pattern where they would get everything done by the half hour. They would, 10:27, they would start, and they'd say, "Be done by 10:30. And it was very interesting because Danny eventually was able to detect that there'd be about 3 waves of sells or buys. And once they finished, the market would fall in the other direction. So that was a good clue. I was always looking for changes in direction in trading the market. But one of the things we tried to instill in Danny was that we didn't want anybody to outwork us ever. And that's sort of what I would preach to you today. I still, to this day, I'm going to be 70 next month, and I still do my work every single night and love doing it because the charts kind of speak to me. I was at a dinner party last night, and some guy who trades asked me, "Well, what do you do?" And I said, "Well, I, half comically said, I draw a lot of lines." And I've got Edwards and McGee, the chart book, in my bookcase, but I've never read it. I just started getting charts and drawing lines, and then they sort of talk to you. And you'll notice levels where when the stock or futures chart comes down to the level, for instance, the last month we came down to about low 1970s in the S&P futures, and it looked like death warmed over at that point. And that's where you get your maximum reward and what you think is your maximum risk, but it's really not your maximum risk because it's a trade you can put on with a limited amount of risk by knowing that you can risk a smaller amount because you've already declined into that level. To the same extent, the market has a way of of tricking you. When everything looks so fantastic, you want to grab a hold of a large number of contracts, and it's usually a sucker play. So I found that by preparing the night before and putting levels in on my sheet that I keep prior to the opening, that serves as a reminder for me to be particularly aware that that's an area where I want to go the opposite, even though my emotions are suggesting that I want to go with the flow. The exact best trade is to do the opposite thing. Danny, I don't want to rattle on. I really wanted to entertain questions from people in the universe there.
Okay.
Specific questions, because.
Okay. What we want to do is let's do this really slow, you guys. Okay. If you do it too fast, we're not going to be able to get these questions, and it's not going to be able to help anybody. Okay. So the question is, slow down, you guys. RS is asking a question. Can you see this, Marty? Can you see that, Jeff? Hold on. Slow down, you guys. Yeah, okay, yeah, don't ask his weight size, he says. RS, question. How do you know it is a change of direction rather than a pullback in trend?
Well, I use the chart.
I draw a lot of lines, and what you're really always looking for is a high risk-reward point. So when something pulls back, you don't know. You're never going to know until the trade plays out. But what you're looking for are lower risk entries. And the problem is that when the opportunity presents itself, you're usually carrying some bad inventory, or you're pissing in your pants. So that's why I suggest that you have scenarios set up from the night before. The biggest thing is you're carrying bad inventory, and that's what makes the trade so difficult. Next, Danny.
Okay. Elliot D. Okay. Elliot D. What strategies do you use to trade the T theory, looking at credit derivatives indicators like you like to watch?
Terry Laundrie developed the T theory, where he said that markets spend the same amount of time going up and down, not necessarily amplitude, but he would then have a cash buildup phase while the market was declining, and he tried to do a match time sequence. That's just another tool I use. I still to this day have about a 20-foot chart on my desk that I keep pasting together, where I calculate and post the 18-day oscillator and the MTO. And when it comes down to certain levels, you always think it's going to be much worse. It's much better at bottoms than it is at tops. But with the advent of the program training and the bull market we've been in, it hasn't had quite the amplitude that it had in more difficult market declines. So it makes it tricky. The thing that I look for in the oscillator is a rising bottoms pattern. When it would come down to a very severe level, invariably it would produce a price retest or new low within 1 to 3 weeks. So what I would look for is a higher oscillator turn, but a lower price than the level when the oscillator made its largest descent. So when I would get a non-confirmation in the oscillator with a lower price, then I would look for a turn. And once I got the turn, I would send it in. That is to the bookie.
Right. Okay, good. YUWA said, how do you use Late Terry Laundry's short-term oscillator to come with a daily basis?
Foolproof thing. There are a lot of other tools I use. For instance, I use a weighted trin in addition to his oscillators. Once again, a high trin trading index, the ARMS index, above 130 to 160 gives you an idea that you're looking for a counter trend move to the upside. It's much better at bottoms to suggest a turn to the upside than it is at tops. For instance, when it gets below 80, and by weighted average, I'm talking about an 18 and an exponential weighted average of 18 and 82. 82 being times the average and 18 the most recent event, so that it's front-end loaded on the trend. When it gets below 80, it doesn't necessarily predict the top because things can stay overbought much longer than your wallet can hold out. So it's much better at bottoms than it is at tops. One other little trick I found is that when you get a trend above 300, it would generally occur when Lowry's would have a 9-to-1 down day. And occasionally in bad bear markets, you'd get a second day. And if you got a second trend intraday at 300, unless it was 1987, you would have a very strong bounce out of there. So what I do is I utilize a lot of different tricks that I've accumulated over the years, and there's no lead pipe cinch. Everything you're trying to do is improve your probabilities of success.
Okay. I got a couple of questions here, Marty. I think one kind of sticks out. Hold on. Well, Dennis S. is asking, oscillator bars or candlesticks?
And channels. I look at candlesticks, but I don't study the different methodologies. What I try to do is look at it viscerally and visually, as opposed to any rule book. I just look at all different things and try to put it into the mosaic. And a lot of things are sixth sense because I've done it for a long time. And one of the things I've lectured about, a couple things I've lectured about, is you should only choose a methodology that it fits who you are as a person. I've said many times I could take 100 people, 100 of the best educated people, and maybe one or two would walk out successfully and become a good trader, because really what would happen is your life's history up till then might sabotage your potential success. So you have to choose a methodology and risk parameters that you're comfortable with, and that's for you to determine what you can handle risk-wise.
Okay, here's that question I thought was interesting. From Greg M. Marty, you started this endeavor as a young man. Do you think it's likely that a 55-year-old can learn to day trade index futures with the advent of algos and HFT? Great question.
The kids were pretty much through with school. I said, this is my Ray Kroc decade. And the last 3 years, I've had my biggest earnings ever. This yesterday completed the month of February 2015. I had by far my biggest month ever, and scared the daylights out of me because it was so good. So I would say that it's never too late. I do think that trading the index futures are extraordinarily difficult. I use them only to hedge now, and they're normally a contra position to what my major option position is, and the reason I'm able to do options, and I sell premium, I rarely ever buy it, is because I have such a large capital base. It's much more difficult, but you can sell a small amount, a few options. There's nothing like the excitement of winning trading the futures, but with the algos, when I referred to that level, we made a low early February or late January. I can't remember. I need a chart, but be that as it may, we bottomed in February 3rd, 2014. I was getting smoked when the market came down, and in the back of my mind, January was bad, and I said, well, maybe we're going to bottom just like we did last year. And so I'd set that scenario up in my mind, but you have to pick levels and be extraordinarily disciplined. It's not quite as exciting, but I think day trading the futures is just extraordinarily difficult. Danny, with me, with 27 years of experience, is scratching them out, but it's very, very hard. And I think what I wanted to point out was when we went down to the, if you refer to earlier in the month when we went down, I had drawn a line across 1971 on my charts, and I think we went to 1973. So I didn't know whether we were going to break 1971 or whether they were going to fish for the last stops. What I've noticed with the algos, in the old days, before the computerized trading existed, when Danny was on the floor, they would have a deck of cards, not playing cards, but they would have stops in their decks. So they would know where the locals would try to aim to knock out the stops, because what that would do was create a fresh supply of red meat for them. And when they got those, that's what I've been talking about. They were getting low risk entry points. It was very similar to the thing that we talked about in program trading in the old days, when we would get 3 waves, and once the 3rd wave would occur, the selling or buying pressure, whichever direction they were doing the program, would diminish. And I always talk about first and second derivatives in calculus. It's like you're driving your car and you're going 70 miles an hour, but you're coming up to a stop sign. You're going from 4th if you're driving a stick shift, and I assume all you wealthy traders out there are driving a very fancy car. You're downshifting from 4th to 3rd to 2nd to 1st, and then when you come to the stop, you're neutral. And then you're going to accelerate after you've looked both ways and made sure the crossing guard is out of your way. And you're going 1st, 2nd, 3rd, and re-accelerating the car. The same thing's true in trading, where you're looking for changes of direction. And that's what I recommend. But the discipline that's required is enormous. Now, getting back to a point I made earlier, it's a function of what your life's experiences have been. And now, see, I'm an inveterate gambler. I was pitching nickels at the corner grocery stores, flipping baseball cards, and all those things, which I'm sure at least half of you have done in your previous lifetime prior to taking on trading. So you have to get that under control. Another psychological thing I talk about is, are you more interested in the action or are you more interested in winning? I wrote in my book, and I didn't become a success start becoming a success till I got married. And I always said that life's not a dress rehearsal. This was time to stop screwing around and become successful. So I buckled down and developed a methodology, and I was able to read a lot of different approaches and incorporate it into my own. I call myself a synthesizer, not a guitar, but a synthesizer, whereby I take different approaches and just sort of see what works for me in my own mindset. If you're going to try to day trade, realize that you're invoking on one of the toughest tasks against some of the smartest people in the world. It's kind of like IBM's computer Watson when they were playing chess against the world chess champion. You got to really be super disciplined. And you have to ask yourself, am I craving the action, or do I really want to win and be successful? And until you can answer that, you should save your money.
Okay, let's move on. Let's see, there was a question about the VIX. Okay. Charlie R. says, does Marty see the VIX as a leading indicator? Any observations on his professional use of the VIX? You know,
well, the VIX is... I made a lot of money in my oil options was when the VIX was high. In December of 2013, after 9 years of trading a lot of oil options and making quite a bit of money, the VIX had gone into the high teens, where it had in the previous years been above 100 and on its way through 50 and then into the mid-20s. And when it declined into the teens, I just felt the risk reward that was left for me was extremely dangerous selling premium. In the S&P, the reason why I like going back to the S&P options is that oil is more of a homogeneous entity, and the VIX in the stock market is, you have so many other indicators to look at, so the likelihood of it having a dramatic move, lately it's been going between 12 and 24. So last summer when it got down 12, 13, it's 13 now, is when my risk increases dramatically. It can stay at the bottom feed for 6 months, or it can stay there for 6 days. You have to start to think about going the opposite direction. So for me, I have an enormous amount of short puts on in the S&P that expire in 3 weeks, and I'm hoping the VIX stays tame for a little while longer. But when I start to put on short option positions at this low level, my risk increases dramatically. So the corollary to that is my size has to diminish. But that gets back to my gambling issue. I like the thrill of having a large P&L, so I have to pull back on my desire to have the excitement and be much more prudent. So I use the VIX as a contrary indicator or a warning sign that, for instance, if we were to have successfully to exit my option positions, which in my case have them go to zero, and I get all the premium, the best thing that I talk about theoretically is letting the VIX spike up and then come in and hit them with a lot of premium sales. But I get bored, so I get involved. But it's useful in that regard. I traded the VIX options one time, and it was a disaster. I put them on when the VIX was 12. This was a number of years ago when they first came out. And the VIX spiked, but I couldn't get out of the options because they didn't go anywhere because they were a European expiration, I guess. I'm not quite sure whether I'm phrasing it right. But the VIX index went way up, but my options did nothing. So that experience left me, it was like kind of a very bad date. I didn't want to go back again. One other thing that I wanted, I think you've got the Market Delta fella coming on. One of the things that Danny's found with the Market Delta, this is a 30-second commercial. No, I'm joking, is that he seems to have different indicators that help you identify turning points that Danny puts out on his IM during the day. And when he gets a series of sequences of buys or sells, sometimes that's useful.
I can't see the question right now, but somebody asked, what did you learn from your biggest losing trade?
That capital preservation is the most important thing you can have, other than making a lot of money. That's the old story. I love numbers. So if you lose a third, I think you have to make 50% return to get back to even. So somewhere in that ballpark. It's very important to not let your losses get out of control. I mean, one of the things you should think about prior to entering a trade is considering how much you're willing to lose in that trade. Now, one of the best trades I ever made was a huge loser. On October 16th of 1987, I went home very long because it was option expiration day. I think the market was down 108 points that day, somewhere in that range. And I thought it was being pushed down by the option expiration. And so I went home long, and we cracked the next Monday, where we ended up being down 500 and something points, 16%. But what occurred, I'm going to get some water, Danny, at some point. But the market opened down 200 points and rallied it down 100, at which point I hit the exits, and I lost many hundreds of thousands of dollars, but was very happy to have done it, because had I stayed in, I would have really been hurt with a much greater loss. So that was a very good decision. The interesting thing was I also bought options on Friday, and the VIX, the volatility index, increased so much they actually suspended trading options for a while. But the volatility increased so much that I was able to get out of the options. That's not the problem, it's the ice in there, Danny. That's the problem. The options had increased so much in volatility that I didn't lose that much money. I was shocked, but that was an interesting lesson as well.
Okay. Well, you know, I think we all will agree that based on the volumes, we all know that there's less trading going on in the futures right now, and Marty's moved as one of the premier futures traders in the whole world to options. So let's get a couple of option questions in here. Mark L says, how far out of the money do you sell premium?
Or portfolio insurance have premiums that are 2 to 3 times as large as the calls, because the market seems to go up more slowly and methodically than it goes down. There's some sort of exogenous event. So that I've been selling puts that are 300 plus points out of the money. And calls, they can be 80 to 100 points out of the money. Because if the market had a big rally, go up 20, 30 handles, I can adjust my position. The other thing I utilize are firewalls. And I don't know how many are familiar with that, but what I'll do is, for instance, I'm short a lot of 2180 calls, but I'm long the 2200 calls on a back spread. That way, if I have to adjust, but it also diminishes my margin requirement. But on puts, I'll be at least 200 to 300 S&P points away which are 1,600 to 2,500 Dow points. So you would have to have a cataclysmic decline. The problem I would encounter if it were to occur would be the VIX exploding from a low level and requiring me to put up a great deal more margin, at which point I would then put on firewall put spreads, which I do all the time, where I'd buy the 1850s and sell the 1750s, and then after the market stabilizes, I would sell out the 1850s once I feel comfortable that the tornado or thunderstorm is over with and I can go to get out of the storm cellar.
Marty, this is from Greg. Marty, it's very difficult for a small trader to sell premium. What would you trade if you were starting to trade with a $25,000 account?
Sell one lots.
Sell one lot.
Sell two lots.
I think he's right there.
I know I'm right.
Yeah, start small and work your way up.
I had a motto when I first started out, which was 1979, and I had nothing. I bought a seat on the Amex. It's all documented in various publications, and I borrowed money from my in-laws. I borrowed $50,000 for working capital, and I think my mother-in-law was very upset when I paid it back in 6 months because she didn't have control any longer. But the first year I did it, I made $600,000, so I was on my way to financial freedom. I had a saying that if I made money every day, every week, every month, and every year, nothing bad could happen to me. So with the $25,000, I think you're sitting pretty. I don't know whether you'll make a living doing that, but you can make a return. You have to have a realistic objective. You know, would you be happy with a 30% annualized rate of return, which would make you better than Warren Buffett if you could do it for 40 or 50 years? Well, you're only going to make $7,500 in the year. So you have to have realistic expectations. If you're going to try to make $250,000 on your $25,000, I got some money in my wallet that says you're going broke. So you have to have realistic expectations and be very, very patient. But if you can be profitable most months and be profitable for several years, the capital will grow. That's what's happened to me, and it works. The main thing is to prevent losses.
Kelly
Sorority house.
You asked the question, Marty. How do you choose which options to sell in terms of deltas? Explaining to you, he says the delta's a sorority thing for college.
I just try to determine my risk.
Listen, I can tell you what Marty does.
And
he's
you incorporate. You can't just ask a singular question in that regard, simply because of the fact that you have to assess where the VIX is,
right,
where you think whether your market's in a positive or negative mode, direction, whether you're above or below your indicators, or go back to my book where I talked about red light, green light. Remember, the red light district's more expensive than the green light district. Anyway.
YUWA says, for the T theory, short-term oscillator, look at the direction, zero line, it is if you're just non-confirmation. Listen,
well, the theory behind the T theory
short-term
is
oscillator,
that
do you look
at
the direction, zero line,
oscillator leads,
or just non-confirmation you mentioned?
And the idea is that the oscillator precedes price movement. Joe Granville used to have a thing, I think he used to say, volume precedes price. So that you have to, there are no hard and fast rules. You have to, it's kind of like going into a coal mine. You got to go down there and experience it and look for patterns. I'm working with my kids now, and I keep explaining to them that you have to utilize these indicators over and over and over again till you acquire a familiarity and a confidence level where you can then tee it up. The oscillator presumably would lead price, but it's a function of your interpretive skills.
The oscillator presumably would lead price, but it's a function of your interpretive skills.
I utilize those in oil when I was trading options.
Michael, at what point do you adjust your deltas against your negative gamma?
You know, my son had worked on an options desk, and he was at University of Pennsylvania, and he was in arts and sciences, because I'm a big believer in a liberal arts education. Everybody always said, well, why didn't you go to Wharton? I said, well, it's better to be well-rounded. You know, you can always learn that later on. So I got him a job in the summers working for an option firm in New York, and every time he would take a class at Wharton, I'd tell him to go kick their ass and get a straight A, which he did every time. But when he took the option class, he could have taught the course. But being able to teach the course and translate into money and profits is a whole different course of life. So I can't exactly, it's really a function of your risk tolerance. So it's not a question, it's kind of like an algebraic equation you're giving me, where you can solve it if you can hold things constant and have one unknown. But in this situation with an algebraic equation, you can't solve it if you have several unknowns. And that's why I can't answer the question for you.
You can solve it if you can hold things constant and have one unknowns. But in this situation, Ted Hughes, Marty, what's your view of the S&P 500? You have several unknowns.
There are 500 pieces in it?
Yes, yeah, there's 500 stocks in there.
I can only give you a comical story because I can't give you an opinion. The story is, when I had a seat on the Amex in the mid-'80s, I had some office space upstairs with a large specialist, and he had a fellow trading for him, and he was sitting in the room upstairs trading, and we all had jackets on the floor. And in those days, to be on the floor, you had to make an appearance, but you didn't have to stay there all day. You could leave orders with a broker, a $2 broker, and leave. So in the middle of the morning, I went to the floor short position, and I went down the floor and put on a couple trades and left some orders with brokers, and I came back upstairs. And when I got back upstairs, I was long. Well, the guy was very upset with me. So he started swinging an aluminum baseball bat in my direction. And I said, there are two things wrong here, Jerry. I said, A, you don't subscribe to my service, which I don't have. And the second thing is, I'm not responsible for, I'm just trying to feed my family. I'm not responsible for what you do. I went to the floor and I saw something, and I went from from short to long, and that's life.
Well, I guess what he's again, I think it goes back to options trading. You know, he doesn't care if it goes up or down. In fact, he just wants
to change my mind based.
You know, as an option trader, you just want, when you're selling premium, you just want it to do exactly what it's doing over the last couple of weeks. Let's see what else. You know, I can't give you a forecast.
Is to be flexible and not be the problem that the majority of people that lose have is that when I used to, before I became successful, I used to say, well, I will things to happen. You know, I want things to happen. Well, that doesn't lead to trading success. And I'm sure that's the problem of a majority of people in the audience who are trying to find the Holy Grail. You have to be very honest with yourself and be flexible, and that you can't be dogmatic. And one of the things is I've stated over and over again is you can't desire the action more than you want to win. Excuse me. And I didn't become successful until I decided that winning was more important than playing. The values.
I found a good question. This is Bobby R.
My work ethic has not changed, but I love markets because I view them.
Have your tactics
when,
changed?
like when you're a
Since
child.
the Pitbull book was written.
Yeah.
Sure, every time you look at the viewer, my tactics have changed in the sense that as my capital increased, I went in the direction of selling premium, because with the knowledge that most options expire worthless, that seemed like a better game than the futures are very difficult now, because I'm astounded. If you think back to what I told you about Danny when he was on the floor with a deck of cards, the brokers then knew where the stops would build up, and they would tell people where the highest incidence of stops lay, and that would sort of act as have a magnetic pull in that direction. To the same extent that the stops were determined by human nature. They wanted to risk X, or they were getting out at the low of the day. Danny and I are not very good singers, but we composed a song about take out the highs, take out the lows. Well, that was based on old school crowd running the stops. To the same extent, the algorithmic trading methodology seemed to target what the psychological levels where you would place stops, and they're quite good at that. And they try to, one of the things that Danny's pointed out to me with the market delta is after they run stops through a level, and then he'll flip up a certain number of buys after a decline, he'll notice that the volume has diminished, has abated on the sell side, and then it'll flip to the buy side. He can see that on his market delta indicator, and that helps him go with red light, green light, the change of direction, et cetera, et cetera. However, nothing's guaranteed in life. It can be false. You can get hit with another wave of selling. You can certainly have something occur in the news arena or whatever, but then you're always looking for lower risk entry points, but you must then utilize the discipline of defining your risk and not pyramiding into a position. Now, I know lots of people that pyramid into a position. Well, that can work. It's like going to the roulette table, the old theory about betting black or red or odd or even. If you have enough capital, eventually you'll get your money back, but the house has figured that out, so they limit the size of the bet, and you're probably limited by the size of your capital, so that doesn't work. And to the same extent, pyramiding your position to prove to yourself that you're right, or going back to the psychological of, I said, willing my position to win, is not what leads to fame and fortune or happiness.
That's for sure. But you know, like in the old days, Marty, when I picked up the phone for you, and again, he was Marty's probably the most demanding trader I've ever worked with in my life. And as I've said, I've worked with a lot of traders. But in the old days, what we would do.
To call me a bad name?
No, I would never do that. But anyways, we did. We went at it on the phone. You know, there would be good days and bad days, and I think it all goes back to making money. If you're making, he was in a great mood. You know, we could
play much better golf when I'm making too.
Right, you're much better at golf when you're making. But in the old days, if he was long and he knew I had that UBS program line, and he knew I had more capital on the other side, the S&P would start to downtick a little bit. He'd pick up the phone, he'd go, "What are you doing?" And I'd say, "Hey, eight even on 100 and sell 500. He'd go, "Oh, fuck you," and hang up the phone. So that's how that went. But like he's saying today, we get attacked by these algos, and we never even see them coming. And like he said, you could get down to a low where you kind of think the program's evading, and all of a sudden you can see a couple buys, and then whoosh, down they go again. So, you know, when it goes to this futures trading, I'm going to be the first to admit it. You know, I don't make on every trade. I struggle. I do see the levels. I do understand premiums, and I do understand volumes, and like Marty said on the charts, I'm very good at reading those charts. If there's people in the room that are my room that know me, they know. They can say it right now. I pick highs and lows all the time. They look terrible. You know, Marty will pick me up. "Ah, this stuff's horrible." And I'll say, "Marty, they got to do this morning sell program, and then they got to run them back up, and then we'll figure out what they do later." But there's always a two-way trade in there. You know, they got to run those buy stops. They got to run those sell stops. Let's see. A couple more questions. I mean, you know, Marty, I don't know how much longer Marty wants to stay, but let's see. But here's the thing. You know, we're not going to be able to get to all the questions, but let me see if there's a couple more questions that we can.
I guess he's trying to say.
Anthony,
what I found
is a lot of traders
market has different nuances.
To trade multiple markets at once.
In the early days, try to trade
S&Ps
and bonds. And bonds I could fall asleep with. Would you say that's true?
I.e., would you trade
to the S&Ps
futures
in the old days before the Fed got involved with manipulating every market in the world?
And options at present. I mean, I guess he's trying to say.
I think each market has a different pulse beat. And I'd rather specialize at something than be a cook in all different venues. I found oil to be dramatically different than S&Ps. I think each market, you know, bonds, you're talking about governmental agencies and currencies impacting their price movement. The reason why I like the stock market so much is you have thousands of barometric readings with individual stocks, or you know, in the old days, 30 years ago, you'd watch General Motors and IBM, you know, as your barometer, how they were acting. These days, it's Apple and something else. So the point being is that it's much more diversified in the stock market, so you can get many more inputs. If you're trading oil, it's the price of oil. Yeah, they're there. One of the things that drove me crazy there was the West Texas International Brent spread. It would go between flat and $28. So what you'd have all your positions in WTI, and it'd be being pulled along by events in Europe, and Brent would be moving WTI. So I found that that was one of the reasons why after 9 years, I took all my money and said, "I'll see you later." Bonds, I found them extremely difficult in the sense that they're slow. They're very, at least they used to be very, very slow, and they're more of a homogeneous entity. So, and they also would trade. I had one guy who became a big hedge fund guy I interviewed about 25 years ago, and he said, well, they would always put their positions on before the news announcement came out, a day before, the afternoon before, because they wanted to gamble how the market would react to their news, and they would bet on that. So they're all different strokes. You know, when I ran a couple hedge funds, and people would always ask me in the late 80s, well, what do you think in Europe? And da 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 da. I said, you know, when I master the U.S., I'll go over to Europe. I believe in concentrating and dominating one space, and they all pay you the same amount of money if you're successful.
Here's a good question.
Going to be 70. I won't tell you the date. You can look it up. I don't want too many cards and letters, frankly. I told you when I turned 60.
From N and S. Pitbull, do you think you could achieve the same level of success if you had to start in this era of Algo HFT?
Milkshakes from the McDonald brothers in the 1950s, and he bought out McDonald's and made a fortune. But he did that when he was in his early 50s, and he made a fortune in his 60s. So I found when I'd been successful all along, but I've had my greatest success in the last 5 years. Kids are out of college, never had a mortgage, own racehorses. You know, I get to enjoy the fruits of my labor. So I think the opportunities are limitless. They're only you're only held back by your work ethic and your desire to succeed. I think when I started, I was a security analyst in 1970. That's in the previous century. When I got out of business school, and I worked for 9 years as a security analyst, I had to buy over-the-counter options, and I never wanted that. I mean, that they were, you know, it was 10% for 1 month, 15% for 3 months. You know, you couldn't win. But in the early 70s, they came along with Chicago Board Options Exchange, and they had 16 options, call options, and then they came out with put options, revolutionary things. And these were instruments where I could get leverage. So this was in the early 70s. And by 1978, I had been tired of traveling around the country, and I got married, and my oats had to come to one barn. Yeah, so I had to concentrate on being successful. And more and more leverage vehicles came into being. And with the advent of options and puts and calls, and then futures other than the grains and metals evolving, they afforded me the opportunity to get leverage. And that's how I made my first millions, was going to the floor of the American Stock Exchange and trading options and increasing my capital many-fold. So I would say to you that there's so many more opportunities with different vehicles that your opportunities are far greater than mine were at the time. So go, fight, win, kill.
Because that's what he says all the time. How are you doing today, Marty? He goes,
I want to beat you. Still.
But listen, you know, what I'm going to do, fight, win. Right. Kill. Right, kill. Because that's what he says all the time. I said, how you doing today, Marty? He goes,
yeah,
I'm doing
0
okay.
times 0.
I said, well, that's, they tell me the number. I'll go, that's great. He goes, no, that's not. Because I want to kill him. I don't want to win. I want to kill. But
all those out there, I'm looking for you, too.
What I'm going to do here, I don't, you know, we can have Marty stay a little longer, but he does have stuff planned today.
Increase the fees.
Yeah, I'm going to have to give him a little more zing to keep him around.
Let's see, 0 times 0 is 0.
Yeah, zero. Yeah, right. The zero sum of zero is zero.
20,000 orders.
But here, you know, why don't we do
think
this?
you should
I'm
have
going to take these questions and I'll
mill
try to,
rate tax on
try to
putting
pull
in.
them and maybe email them to Marty and ask him if he can answer some. But there's just too many to answer. But what I want to do is, because he has been a big opponent of program trading, and I want to talk about this particular slide in front of you. One, the spoofing. You know, we talk about this.
I mean, it's
That's when they had Michael Lewis's promote his book or introduce his book. They talked about a company that spent $300 million laying a fiber optic cable from Chicago to New York. Now I ask you, who could spend $300 million on fiber optic cable unless they're making more than $300 million? And it's coming out of everybody's pocket. And they say, well, it's only a penny a trade, and the little guy's doing much better.
you know,
Well,
60 minutes when
my
they had
son
Michael
trades with
Lewis's
me, and he said, I went to
promote
sell
his
some
book,
stock the other day, and I went to hit the bid, and I only got X number of shares, and then they buy the stock, and they sell the stock in front of me, and then buy my stock at a lower price. I mean, it's annoying.
and it's thievery.
Yeah, only
Well, there's a company
Right, only
that's
the guys
filed
that-
for a public offering,
Right.
a high-frequency trading
Little guys doing
operation.
much better.
Well, we'll stay
Well,
off the names.
My
yeah.
son trades with me,
And-
and he
and
said,
they
I went to
filed,
sell some stock the other day, and I
a
went to
public
hit the bid.
offering, which they
and I only
rescinded
got
last year when the publicity shown on them, and that was they had one losing day in 1,250 days. Well, I'm sorry to report that in their new prospectus, they've had one losing day in 1,500 days. So they didn't lose a day last year. So I'm pretty good at my game, and I'm a baseball lover, and I know if you hit over 300, you're going to be making 8 figures a year playing baseball. I know if you're good at it, they're going to pay you a lot of money if you hit over 300. In trading, if you bat over 50, 60%, if you're using discipline, you're going to be making quite a bit of money. But you're sure as hell not hitting 99.99999% of winners. So I ask you, where's the SEC, where's the CFTC, and what rock are they sleeping under?
That's a good question. You know, zero.
I'm a big believer in charity.
Well, listen, I want to thank Marty Schwartz.
You know, a couple of guys asked if you'd come back and do this again sometime. Would you consider it? Can we, I mean, am I going to have to double your pay, or, you know, zero plus zero?
I'm a believer in charity.
I'm still getting
Well,
royalties
listen,
from
I want
China.
to thank
I'm
Marty
gonna check
Schwartz
a
saying,
week-
hey, you guys,
a
I want
week
to thank
ago.
you guys, and I don't want you to leave. But, you know, look, if you've never read this book, you really have done some harm to yourself. And the only guy I'm really interested in reading is Marty. You really should get this book. It's Jack Schwager's book. And, you know, he's got,
My book.
and the Pitbull, and the Pitbull book, I got that up, I had that up on your slide.
I'm still getting royalties from China. I gotta check out
You got to get that.
a week ago.
Yeah, he's still getting the money from China.
It's coming.
Well, listen, thanks so much for coming in,
All
Pitbull.
right, my pleasure.
You're the best.
I gotta go to the horse races now.
Yeah, he's going to the horse races. Yeah. Okay. He really is. I hope this was, you know, you guys, this has been a really, really fascinating time. And please, do me a favor, stick around for a little bit, because, you know what, look, there's a couple, this isn't going to take that long to show you some of the things that I've been using since I left the trading floor. Okay, don't leave, because I didn't ask Marty to talk about market delta. Okay, he's had me on an instant message the last 25 years, or talking to me on the floor, and I've learned to read these charts. I may not know what I'm reading.
Finally, get in the pit and hit that guy.
That's right. Get in the pit and hit that guy. But anyways, listen, I'm gonna move this thing forward a little bit, and I'm gonna just hit on the trading floor stuff that happened recently. The CME announced that they're going to shut down the pits, the futures pits, the CME, and the Board of Trade in New York. Okay, I'm here to tell you that that's not new news. Okay, and what I'm going to show you is I'm going to show you some pictures that were taken yesterday on the trading floor of various futures pits. And you know what, I'm going to explain why this is happening, and I'm going to explain why it's a good thing for the markets, because at the end of the day, there's cost to having 2 trading rooms open. There's the Board of Trade grain room, and then there's the financial room. Right now, they could have fit everything into that financial room a long time ago. And at the end of the day, let me show you what it looks like. Okay, in the upper top is a soybean pit. Okay, that pit used to have 500 guys, 300 guys in it. There's nobody left in there. Okay, and then when you look below, that's the S&P futures pit. Now there is some guys in there, and that right now that's probably not the best period of the day. But what you'll find, and I'm going to tell you guys something, lease a seat if you're trading. You can lease a seat. You'll lower your commission rates. Okay, I mean, and again, don't ask me who you should go to. Pull out the Merck CME clearing list and pick a clearing firm. Go lease an IOM seat for $250 a month. You'll lower your rate so much you'll fall off your chair. That's if you're a decent sized trader. Okay, so the S&P pit's still inactive. But if you go over to the right and you look at the Eurodollar futures pit, I didn't put up a picture of the Eurodollar futures pit because, I mean, everybody knows back in the day the bond pit had over 600 guys in it. The Eurodollar futures and options area took up half of the entire upper trading floor, the CME. Look at it. There's 2 guys in there. I mean, come on now. Are you talking about saving this for what? So people can, you know, go to work and say they're going to work? Well, these guys aren't making any money in there anymore. And the guys that are making money are in the options pits. And I hate this, well, in the futures, S&P futures too. But forget about trying to make money in the corn. You know, they had this lawsuit against the Board of Trade or the Merck about the changing of the rules for the, for the grains on their opens and closes. Come on. You know, what are you going to do? You're going to hold the exchange open to fill, 500 contracts, 1,000 contracts? No, you're not. There's people that got to be in those pits. There's pulpit recorders. Think of all the costs that's associated with keeping futures trading pits open like that. I mean, they've done it for years. And they said that they would take these things to a 99% threshold. The futures pits don't even make up 1%. Come on now, guys. Yeah, I agree. The gladiators, I love them. I am a gladiator. I traded in that S&P pit. I fought. Marty used to tell me, go get him. I whacked Wally Posner so hard, I knocked him onto the floor. And, come on. It's over. It's just over. It is. And let me show you the next, and then up on the right-hand side, that's the corn pit. Oh, no, and the lower is the corn pit, I think, and this is the wheat pit. Wait. Well, it's the corn and the wheat pit. And in the wheat pit, there was like one chair. There's a chair in there, and there's this big overweight guy sitting in there, off to the side of the corn options, and, geez. It's just not worth it. Okay, now listen, you guys. In order to keep this going, I've told you I'm going to show you some. This is just me, okay? No one helped me with this slide or anything. This is about me learning to read charts. Remember, I'm a floor guy. In the old days, I had the boards in front of me, and I could have put up a picture of the boards and all that stuff too. And the boards, I had the last 7 prints. So after seeing those last 7 prints go up and down, up and down, up and down all day long, I would connect to those prints. I don't care what anybody would say. I'm not your chartist, okay? I always tell people on Twitter, I'm not your chartist. I'm not as smarter than you when it comes to chart. But and I'm going to lay this out there. Chance Stroud, a good friend of mine, gave me these charts. And he knew that I could read, but I didn't really know what I was reading. And as things developed in my room, and I can't keep up with it all day. I got to tell my own people in the room it's hard to keep up with because every second I'm saying, oh, here, 3 buys, 650 ESH bought, 6 buys, 3,500 S&Ps bought. So what I'm looking for is when first of all, I'm still a bull. I'm always a bull. You know, as long as the Fed's going to have zero rates, it's going to be hard to fight this market. You know, is this year going to be a turning event for the S&P? I mean, I'm a bull, and I hope so. I want to see the downside too. You know, we always say if the markets are going up, we want to go for the ride. If the markets are going down, we want to go for the ride. But I also say that we're not here to fight City Hall. And I think the Fed's City Hall. You can call it the PPT. You can call it anything you want. But these markets have been going up for 6 years. And how about this last push? The S&P rallied 5.5% in February. What the largest gain since, what, January 2011? So anyways, well, yeah, you know, look, the charts are set up somewhat in candlesticks charts, but what they are is every time, I can't enhance the chart. And again, Trevor's coming in to talk about this right after me. And I think what I told Trevor when he said, what do you want to do? You know, what do you want me to do on this webinar, Danny? I said, just explain volume imbalances and delta, because at the bottom of the chart is the delta, okay? And on the right-hand side is, if you could call this the Stottlemyre, you know, Stottlemyre on the right-hand side. It's volume. And if you look at that, if you look all the way over to the left, and you look at that bottom print, it says buy. But then if you look over to the right, you can look, what Marty was talking about. There was no volume on that. I'm all over that. When I see that, I come flying out in the room, and I start pointing out this stuff, saying, look, there's no volume on these ticks. Oh, look, there's, you know, 3 buys pop up. 4 buys, you know, 2,000 minis bought in the last 4 buys. So, Trevor, you're jumping in right. I got one more chart. Now, this is the moneymaker chart, and this is really something. This shows me even more in depth of the buys and sell imbalances. And hey, Trevor, how you doing, my friend? Here, pop on. You can hit you got your volume?
Hey, man. Can you hear me?
Can we hear Trevor? Okay, good. Okay, great. Now, the last time that Trevor and I did this, it was the first time. I want to go real quick, a little story about how I met Trevor. You know, life is funny like this. You just never know when you're going to come back and run into someone you met before. But when the Merck bought the Board of Trade, and I hate to say, yes, they did buy the Board of Trade. They were very nice by saying that it was a merger, but the Merck bought the Board of Trade. And we actually, when we came on the floor, you know, the S&Ps were the first pit on the floor. There were guys in the 10-year note options wearing say no to the CME. Well, as I've said it a couple of times, I think the Merck said that, you know, start those things out at $100 a day until they take those things off. And, you know, within a week or so, those buttons were flying off. But anyways, when we were finally getting the move ready to go from the Merck at 30 South Wacker over to 141 West Jackson, we needed an office. And actually, Trevor, I think your table's still right here. But anyways, we were getting a tour by one of the real estate people at the Board of Trade, and the lady marched me into Trevor's office. I didn't know who he was. I think he kind of knew a little bit about me, or he did after I went up there a couple times. And, you know, Trevor was trying to show me this stuff. Well, I was more interested in getting the office. We needed a place to move into, and he was moving out, and I ended up buying a bunch of equipment from him. And then years later, you know, and he had emailed me a couple times saying, hey, Danny, you know, I got this tool that I think is really good for locals. You know, you guys aren't real big on charts, and you really like the visuals. And, you know, I think this is something maybe you and I could work with on. But you know what? I'm a dummy. I'm a big floor guy. You know, oh, I don't need that shit. You know, blah, blah, blah. You know, and then years later, one of the guys in the room says, hey, Danny, have you ever seen Market Delta? And, you know, and I'm like, Market Delta? You know, I think I heard of that before. What is that? You know, and then they send me these charts. And then someone says, oh, yeah, you know, I want to introduce you to Trevor from Market Delta. So we get on the phone. Right away, I knew his voice. I was, Trevor? Is that you? He's like, yeah, Danny, that's me. I was like, Trevor, from Market Delta, I bought the office equipment from. So, you know what? We've actually, we have a good relationship. We know each other's, we respect each other for what they do. You know, he knows I'm a professional on me doing what I do and trying to help people. And really, that's what I'm out here to do. I'm not out here to really sell a bunch of crap to people that, you know, are going to come back and say, hey, you know, why'd you get me involved in this, Danny? I don't want to be part of that. I don't want to be part of anything that hurts people make money. That's my theory. In fact, a lot of times when people are trading, I'm even happy to, if someone's short and I say they're going up and the market goes up and the guy gets out, I'm happy he got out. He didn't lose any money. So there's two ways. You can make on the trade, and you can get out of the trade, and that's what Marty was talking about. His best trade was actually a loser. So anyways, Trevor, thanks for coming in. I'm going to let you take it away. I'm turning my shit off, and
All right. Thanks, Danny. Really appreciate it. It was great sitting in here this morning, listening to Marty and you. I think I enjoyed it probably just as much as everybody else. But I want to take a few minutes and kind of go over a few slides about Market Delta, a little bit about, I guess, where just the background of it. It is funny how we cross paths. You never know. Just I guess it goes to show you never want to burn a bridge, because you just never know how things come back later on in life. But we met, like he said, several years ago, and here we are today. But a quick background on myself and kind of what Market Delta, really what it is. And I'm only going to be 10 or 15 minutes. This won't take too long. But I was a member of the CME, and I was trading off the floor. I was trading E-minis off the floor. And like everybody, you're always trying to sharpen your skills and figure out better ways of doing things. And the one thing is off the floor, as an off-the-floor trader in the early days, this is when they only were trading, say, 25,000 E-minis a day. Well, that was a big day. I felt like I was flying blind. I could hear and see all the volume going on in the pit. This was back in 98, 99. But on the screen, I was having trouble translating that activity. Just bar charts and candlestick charts and just the traditional tools and technical analysis just wasn't doing it for me. I'm not saying it doesn't work. I'm just saying for me, I knew there was more going on. I could see it on my dome as I was clicking and trading. And with all that price and volume information from the electronic trade, I'm like, there's got to be a better way to do this and put it all together. And so first, I was a trader. I'm an entrepreneur, but I'm a trader. And I tried to go find it. Where can I buy this? Who's done this? Who's built this for me so I can just buy it and use it and start using it in my trading? And of course, it didn't exist. So I started prototyping, putting some stuff together. And long story short, that's when the footprint chart was born. And the whole idea of it was to really provide traders more transparency into the markets they trade. And so like I said, I was at the exchange, but I was trading upstairs in an office. And some of my buddies, some of the trading buddies saw it. And it's one of those things where this is something I had just developed for myself. But I could see the need, and I knew that this was going to be a trend. The floor I thought it was going to be gone in a couple years. This was 15 years ago. But here it is, we are today. Now it's finally closing up. But I knew there would be a demand for this type of information with the screen, with everything going to the screen. And so that's where Market Delta was born, and that's what the footprint chart is. So the whole idea was just to give you more transparency, more precision, more confidence in what you're seeing, so that it's not so much of a just reading a chart, but you actually can get some of the emotion out of the chart. So just like you heard some of the stories with Danny and Marty talking this morning about their stories of the pit and the brokers and all the the yelling or the shouting out of an order. Well, you don't get that on the screen when you're looking at a bar chart or just a chart. You're sitting in your office, your basement, at work, wherever you look at these things, and it's silent. It's just silent, but you might see a big move. And it's hard to relate what's really taking place. When you just see it move, it feels there's millions and millions, billions of dollars transacting, but it's so quiet, and you can't really get a feel for what's going on. So the idea behind the footprint chart, and I'll show some examples, but the whole idea was to really put that emotion, behind it, put the volume behind the trade, where it's trading, give you a little more understanding of what's taking place. And of course, that type of information is very crucial at certain levels. So just a few things here. I mean, our tagline is see inside the chart. So what we do is we really take a price bar, a candlestick bar chart, and allow you to look inside that, giving you that transparency. So this isn't, I'm not going to go into a comprehensive explanation. I just want you to get an idea that there's more available to you, a lot more than probably what you realize, and just provide an opportunity to learn more about that. So like I said, we let you look inside the bar. It's kind of that X-ray vision. And what you see here are examples of the footprint chart. These, well, this is a bid-ask footprint. I'll show an example here of a volume imbalance, which is the one that we really have been pushing more. I think that's the one Danny's using, and I want you to see some examples of that. But the idea is we let you look inside the bar and give you an idea of how much is trading, how much volume is transacting within the bar, but also the directionality. Is there more aggressive buying, more aggressive selling, more trading at the bid, more trading at the ask? And so you can take that knowledge and apply it at that execution level. So just like Marty was talking this morning, this isn't, he didn't say these exact words, but this is not a system. This is something, this is a chart. It helps you fine-tune those entries and exits. You still would want to have your levels. So like he said, he has his levels, he puts them together the night before. What I would recommend for people, and everybody's different, but I would recommend having those levels. Maybe it's just high volume levels or previous days highs, lows, whatever it might be, and then seeing how these things behave at those levels and begin taking it from there. So here's an example chart from, this was just the other day, I forget the exact, just a day or two ago when I put these slides together. And this just is giving you an example. This is the volume imbalance. And so what we're looking for is opportunities. So this is a volume, just a volume distribution off to the left for the current day. Market rotated up right near the highs of the day, kind of the high of the range. And we're looking for instances where the market moves to a point where it's met with resistance. And I'm not just talking a line of resistance. I'm saying resistant sellers. Sellers see that price level as opportunistic, and they're willing to come in and aggressively try and take advantage of those high prices and sell. And so what the volume imbalance footprint does, it's probably hard to see. I don't know how well this is coming through in your screen. You see these red numbers. That's kind of like that is your signal to let you know that this imbalance, the sell imbalance is occurring. It's an opportunity to step in and either take profits or get short, looking for some sort of rotation down. And the cool thing is you can apply any other indicators or studies you want to these charts. So it's that whole idea of allowing you to see inside these charts. So another example, going back to the pit, it's like being in the pit, being able to see all the volume, hearing a guy shouting over here, or a lady over here yelling an order out. You get to see what's going on. You know it was a sell order, and you can see how much because you can see the numbers right here on the chart. And so it's very contextual versus just watching price up and down tick on a chart, on a bar or candle. So down here, this bottom is the NYSE tick. And so you could see how it had stepped from being higher and increasing to actually negative here. And so that's a nice confirmation. Simple. I'm all about simplicity here. Just keeping it simple, using these types of things to line up and confirm what you're seeing. Here's an example, really two things I'm looking at here. One is what I'm pointing out here is some stops being triggered. How many times, we've probably heard that a lot, stops got hit, blah, blah, blah. Well, what's that look like? You hear it, Or you might see it on a chart where the market moved real fast, but you're not quite sure what happened, how much volume transacted. This is a way you can see right here, all these green. One, that's a big heavy buy volume imbalance. And notice it's all in the offer. So I know I haven't described what these footprints in detail, and I just don't have the time here. Point is, it's all in the offer. It's a stop being hit, or a very aggressive buyer. Market traded up, and then we get the sell one. This happened to be the high of the day. Basically went up, tested it. We got this sell volume imbalance, and it rotated back down. And I'm using this NYSE tick here to give you another example of how that pulled back as well. But just a quick note on these stops. I mean, there's all sorts of different patterns. Everybody's going to look at this stuff different. But one thing, little thing to note is you'll see these stops with these HFTs and stuff. I mean, these guys, when they come in, they let it out, and there'll be a big order that'll just hit. And one thing I like to look for is if the market trades up against, say, a known resistance level or a known support level, and I see then what looks like stops. It'd be like this. So in this case, it'd be all red going down. Off of a resistance level or support level, what you're seeing is somebody get real aggressive up against a level and try and push it in the other direction. So that's more initiating activity. They're initiating trade in the opposite direction, off of a resistance level, similar to what Marty mentioned earlier. You know, you have your levels. When you see that kind of activity, you're seeing a initiative activity from that level. However, if it trades through the level and you see these stops go, well, those are truly, it's probably a stop order being triggered above resistance or below support. And so it's a way to understand where the stops hit, because so many times that's all they're doing. They're searching for the stops, and when they get hit, you know, it triggers them, maybe trades a few more ticks higher, and then falls back, and then maybe rotates all the way back down through. But they're just searching for these things, and there's really no way on traditional charts to identify stops being hit. However, the footprint, you get to see it, and in real time. These things, it just happens in real time, and you can watch these things light up. So that's a little just tip, one pattern that I look for. Of course, you can use this to confirm or deny all sorts of different things, but that's going to be one unique pattern you'll see, and I'm actually seeing it more and more. Just in watching the markets, you'll see somebody let out 2,000 or 2,500 contracts at a pop and just sweep the market. Usually in the S&Ps lately, it takes it for about 4 or 5 ticks, like in an instant. But the cool thing is I know it was a stop, and depending on where we're at in the day's trade, I can use that information to my advantage. So anyway, that's kind of one little example. But what I would like to do, and I know I haven't really talked too much about the product, but besides the footprint, there's all the traditional charting is in there, as well as all the traditional technical analysis and tools and market profile and volume profile. In fact, we're one of the leading vendors for the CBOT for the market profile graphic. But what I wanted, this is kind of an offer for you guys. If you want to learn more, we offer a 14-day trial of the charting software, and you can just visit that link right here. And we've never done this before. I'm not quite sure what to expect on the response, but we have a red carpet service where it's $125 value. Basically, you get on the phone with one of our guys, and they come in and they log in and set everything up for you. Normally, we require a subscription for that, but what we're doing is if you want to take a trial, and then so there's 2 links. Take the trial and then fill out this form. We will get in touch with you this coming week. But you're going to need to fill out this form between now and this coming Friday. The idea is if you fill it out, we're going to give you the free red carpet setup plus the trial. You may be like, what comes with the red carpet? Well, the software is complex, and it gives you a chance to not have to deal with any kind of setup. We'll set everything up, answer any questions. We'll also, I didn't ask Danny about this, but I'll say it, and if there's a problem, we got some other options. But if he wants to provide his charts, we can import all his charts for you. If you're, I'm assuming, a member of his room or the MrTopStep. So however he wants to do that, we can basically, just like I tell people, it's like buying the bike put together versus having to put it together yourself, and really saves a lot of time and can really get you rolling quick. And if you have any questions, there's our phone number. But take advantage of that. Hopefully, either jot these links down or click them so they're open in another browser. But reach out to us this week.
Hey, Trevor.
Yeah. Yeah.
Well, here's the thing. We had a really successful webinar back when we first did that webinar. What do you say that we do a webinar, plan a webinar in the next month so we can really walk people through what we're talking about?
I think that's a good idea, because in 15 minutes it's difficult to get into all the things. I mean, I just touched on some high-level stuff, but really, however you want to do it. But fill that stuff out, because I know we can get people set up with the software and get them at least looking at the charts and learning. Then that webinar could be a great follow-up to reinforce everything. It
really would be.
Yeah. So thanks, Danny.
All right. Well, thank you so much. No problem. And thanks for coming in, Trevor.
All right. Thanks, guys.
And next up, you got it. And next up is my good friend Stuart Petterman from London. How are you, Stuart?
I'm not too bad.
Can we hear
me okay?
Yeah, we can. We can. Listen, let me flip that slide for you. And welcome. And thanks so much. I know it's late in London. And go ahead. You talk about your product. But before you do, I just want to tell you guys something. When I met Stuart, I couldn't have been more impressed. The guy flew from London to meet me in Chicago. And he brought his daughter, beautiful young lady. And I'm going to tell you something. This just isn't a squawk service. It's much beyond a squawk service. He's got a lot of moving parts there. And it's a great product. And it is now the #1 squawk in Europe. And I think it's going to be quickly become one of the #1 in the United States too. Okay, so Stuart, you go from.
Thank you, Danny. Thanks for your kind words. And I understand the weather's still just as cold out there from when we and Stephanie came. Anyway, hi guys. What I want to talk to you about is news for traders. Now, a lot of people, are aware of the Bloomberg services at $2,000 a month, which is pretty much like standing under a waterfall to get your toothbrush wet. It's just too much. It's news overload. What we developed was a news service that beats Bloomberg, beats Reuters. How do we do it? Well, we've taken, and we are the only squawk service worldwide to take on and get accreditations for all of for the major central banks. We're 80% accredited for the Fed now. We can't say we've got it yet, but we're a long way down the road for that. For example, how does it help you? ECB, to give you the list of who we've got as accreditations: ECB, Bank of England, the Bank of Mexico, Brazil Central Bank. Obviously, the one I'm going to really hone in on is the Swiss National Bank. Now, the Swiss National Bank, I don't understand. I don't know if how you're aware, how many of you are aware over this side of the pond, but when they took the floor off, we got that news out 1 minute before Reuters. Now we've still got the crates of champagne out here, and it was probably our best squawk in the history of the company, which by the way has been going for 10 years now. So what we've done, so we've extrapolated that service, and now we've come to the ECB conferences, which will be done for the same for the Fed in the future. Majority of people will watch either Draghi or Yellen on the TV, the typical way is CNBC or Bloomberg. We do direct wire, the phone in. It's a little bit like a conference call. We achieve 7.5 seconds ahead of the traditional TV channels. So the point being is this service now is the fastest news wire, and it's just a salient service purely and simply for traders. And it's nowhere near the cost of Bloomberg. We're talking, I'm doing a promotion with Danny, but because he's been so kind to me, I mean, this service, we're throwing it out, correct me if I'm wrong, Danny, it's $99 for a month. So it's, and everybody will get a 3 weeks trial. So, the thing is, we get embargo, once you're accredited, we get embargoed reports. We will never break the embargo, of course, but it gives us the time to hit out, and rather than give you 30 or 40 pieces of written dialect from the central banks, which is the traditional Bloomberg or Reuters or traditional news way, we will take out the most market moving points and broadcast them instantly over the airways. We will supplement that with written stuff on our whiteboard. But the point being is, you're getting this stuff out. Now, if there's a rate decision, we're 5 seconds ahead of Bloomberg on average. On every single thing that we've done, we have done it and made it better. I think that's where me and Daddy get on so well, because we're always trying to change the game. I've got, so things like this really do matter to you, the traders. You now are in a situation where you're these people, these algos are running off of Bloomberg. Well, you're actually ahead of them, in some cases. So, the stuff that comes through that you're not, like the PBOC. I don't know how many of you know that they cut their rates today. It's not, obviously not out there. But so the thing is, we've got retail products coming out. I think Danny's seen it. We're working together with Danny to do a sort of a live squawk MrTopStep collaboration. Now this is this is going to be good, and please follow us on Twitter and stock tweets and the like, and you'll see as the new products are rolled out, you'll see them come on. A little bit more about live squawk. We started. I owned my own oil trading. I was as a local, as my biography probably says. We came out. We developed live squawk, and it's since grown, and we've now got offices in Chicago, London, and Singapore. So we know it works. It's proved we work. We are without doubt the leading professional supplier in London. We have 90% of all the professional trading houses. We offer, the subscription would either taken monthly or yearly. So that's where we are at the moment. The new interesting stuff, where we're looking to change the game. We're taking military technology to the markets. Now, military technology. So I'm sure the oil numbers were talked about last year by Marty. The oil inventory figures. The oil inventory figures are done. They're delivered on 3:30 in European time on a Wednesday. What we've developed is drone-based technology to infrared measurements of these, and we're going to be getting your numbers. We've done tests. Our biggest discrepancy so far has been 0.14%. So we're going to be getting your numbers out, not on Wednesday, on Monday. That's probably over-engineered for you guys out there, because it's you've got a lot of movement in beforehand. But to have the information at 3 o'clock on a Wednesday, I mean, you can see the benefits right there in front of you. Now, the next thing, what we've developed, is satellite technology. Satellite technology for the crop report. Through satellites, we've mapped the crop belt. There's all sorts of spectral response and the things like this. So you really don't, it's over-engineered for everybody. But it basically tells you the wheat, corn, whatever, on the speed of growth. You can measure it, and we're going to be delivering those figures early too. So the bottom line of it is we're trying to take Bloomberg on at their own game and do it better. Are we as big as Bloomberg? No, of course not. Are they now producing it? Are they now quoting our news? Yes, absolutely. So we're definitely doing stuff right, and by the central banks giving us accreditations, we know we're right. We've been going 10 years, and our listeners are coming up to 36,000 people now in Europe, and we're about to take on and develop this in the States, of which obviously I've just said we're 80% done with the Fed. So I implore you to look at us on Twitter and stock quits, or take a free trial, but obviously go through the MrTopStep, who we've had our partnership with for a year, and I mean we're as tight as hand and glove, I think, Danny. But I think I wanted to keep it nice and brief for you, and I'm happy to send it back over to you, Danny, if that's okay.
Thank you very much, Stuart. You're a great guy, and I know that this news services traders always have a lot of stuff on their desk, a lot of things that they're looking at. But I'm going to tell you what, this is one service that doesn't need to clutter your desk up. You put some speakers on, and you're getting the news as it's happening. And I'm going to tell you something. He's 100% right about what he said. We see news coming across out of Live Squawk before it hits some of these tapes, before the algos have it. But anyways, listen, thanks a lot for coming in, Stuart. I know it's late in London, and we'll make sure we get that link out, and we're going to keep pushing the product as hard as we can.
Thank you, Danny. Yeah, you're dead right. Just to pick up on your point, or maybe I should have said it earlier on. The most in our day when we were on the floor, the most overutilized sentence was the years. Now it's the most underutilized sentence, right? So yeah, that's the way we took it. Yeah. Yeah. So no, thank you ever so much for your time, everybody, and you know, please, like I say, take a look at us. And Danny, we'll be over to see you soon for another steak that was from a Tyrannosaurus Rex or something. It was huge, that thing.
Yeah, that was Gibson Steakhouse. Okay, thank you very much.
Thank you. Good luck, gentlemen.
Later. Okay, you know what? Now we're gonna kick this into gear. I told you we would, and we're gonna. Now, do buy and sell imbalances matter? Now, I think they do. I think they matter in just about everything we do. We just can't figure out, you know, we're only looking at futures and options and stocks and stuff like that. But do buy and sell imbalances matter? I believe they do. I've been following the New York Stock Exchange closing MOC imbalance for the last 30 years. And you know what? And when it was in the S&P, I want to explain this really quick, because before electronic trading, there was these long and short books by the big banks that held big S&P futures position, whether it was for a hedge, whether it was a program position, whether it was against an option, whatever it was against. There were long and short books, and they made markets for big customers to come in and buy or sell cash stocks or S&Ps or whatever. So every day at 2:45 Central Time, I'll say 3:45 Eastern Time, is when these buy and sell imbalances on the New York Stock Exchange come out. Now you can get them on the NASDAQ, you can get them on the PICOs, but I think the most prevalent one is the New York Stock Exchange. Now in my last webinar, I showed you the follow the money chart, and a lot of people reacted very, very cool to this. I mean, look at how basic this is, you guys. You're out there, you're struggling to make money. I am too. Look, I pick levels great. My guys in the room will tell you. They'll say, Danny picks highs and lows, but I can't hold things. I'm like a dodo, you know. Sometimes they go my way and I can hold, but I got to get up and walk around or something, because as soon as the market goes my way, I think I got to get out. And if I just move away from the screen for a little bit, all of a sudden I'm up 7, 8 handles, and, you know, instead of taking a 2-handle profit or 8-tick profit. But anyways, this was in the beginning. This was in November. Oh wait, was this in January? Wait, when was this? This is last year, in October, after the market sold off. All right, after the market sold off. Hey Stuart, thanks a lot. After the market sold off in October, you know, remember in October and August, when it made a low, all these buy imbalances started popping out. You could follow. If you wanted to know where the S&P was going, you could follow the S&P through the amount of money and MOCs it was going in. Every day there was a buy imbalance, and every day the markets went up. So a very, very simple tool. I mean, why would you not want to use it? If you're trading late in the day and you're long or short and you want to gain a little edge, wouldn't you want to look at these buy and sell imbalances? I don't know. I mean, tell me I'm wrong. If I'm wrong, just say it. Hey, we don't give a shit about these things. Well, if you don't, you didn't care about this entire move from the lows there, because during that time sequence, there was almost all buy imbalances. I think there was only one sell imbalance. You can see it in red. If you look at that chart on the right-hand side within the chart, I think there was a $2 billion sell imbalance right on the last, right toward the end of the month. Or was it toward the end? Well, it was right toward where the S&P started making its turning point. And when those buy imbalances started coming in, the S&P went right up with it. So that was chart 1, follow the money chart. And then here's the most recent one. I mean, I don't know what to tell you guys. You want to make money, you got to have the balls to pull the trigger. But at the end of the day, look at this. I mean, the first 10 days, January goes out with almost a $600 million sell imbalance. And then February, we were closed on the first day of February. We have 10 buy imbalances, and look what the S&P did. I mean, am I imagining this? I'm not imagining this. So, there's 2 ways to use it. One, You can try to trade it off it in the, you can try to make some trades off it like we do in the S&P late in the day. And I'm going to bring Marlon in to explain that. But I also think it's got a lot to do, like if you're an option trader and you're trying to position trade, you know, and you continue to see these buy imbalances after the market made a low. I've got that trading rule that it takes days and weeks for the S&P to go down, but it only takes one to bring it back. Well, this is the start of that. Okay, on February 2nd, out of the, you know, after all these sells and the markets are going down, in comes a $500 million buy, and then on the 3rd, almost $1 billion to buy. On the 4th, almost $1 billion to buy. This is mutual fund flow, guys. This is what's been creating this thing that we see every day in the S&P. The S&P goes up a little bit in the morning. What does it do? What does the S&P do? It's got to go down to go back up. That's how the game is played. The algo's got to shove it down, run some stops, get people short, and then all those little buy stops going above the market, and then the algo goes right back up for it. But that said, I think it's the mutual funds that have been doing this in the S&P in the morning every day. They have this little sell-off, and then they just crank it right back up, and then late in the day, out comes this big buy imbalance. Don't you think they knew? Do you think those cash buyers, you know, mutual funds can trade S&Ps? All right, well, anyways, now look, you guys stuck around, and I'm going to make it worth it, all right? So here it comes. I'm bringing on my partner, Marlon Cobb. Marlon, are you around? Okay, no camera, Marlon, no problem. All right, so we're going to move into this. We're going to move into this, and Marlon, you take it from there.
Okay, thank you, Danny. And we won't take too long on this. We'll just kind of go through the basics, because hopefully what you'll do is you'll join us and do some trading interactively, and we'll go over it all day long. But at 4 o'clock Eastern time in New York City, something really magical happens. The largest and most liquid stock exchange in the world closes, and it closes totally balanced. So at 4 o'clock, all the buyers, all the sellers are happy. And they do that through a process called a market on close and a limit on close. There's a whole closing auction that happens. And in order to do that, they broadcast early to try and make sure the floor brokers know what the imbalances are going to be. Okay, so that they can wait, they can shake up the liquidity to make sure that they can close this market in an orderly fashion. And it's really the reputation of the New York Stock Exchange on the line every day going into the close, because you've got mutual funds, as Danny were talking about, retirement funds. You got Russian oligarchs, and you got oil money, and all kind of people have money parked into the New York Stock Exchange, and they count on the fact that they can put stocks in, put money in, get stocks, take stocks out, and get money. So sometimes there's these redemptions where a lot of money is going to come out. It doesn't necessarily mean that they're calling the market necessarily. Sometimes it's just that they need to write a bunch of retirement checks. And then there's times where the IRA money comes in and money has to flow into the markets. And then there's rebalancing times, right? So you have a stock bond fund, and the stocks run. Okay, they're going to have to sell some stocks in order to balance up the bonds. So all that kind of happens, and there's a whole mechanic to the close. So I always call it the mechanics of the close, because we always talk about technicals and things like that. But here we're going kind of through a machine to get into the close. So what happens is around 2 o'clock we get our first look at the imbalances from the floor brokers on the New York Stock Exchange. We've got a couple brokers down there that feed us some data. And we get a sense for whether there's going to be a big buy side and sell side. Now, when I trade ES futures into the close. So how many times have you guys, you had a really great day, and then all of a sudden the market goes kafooey on you in that last 15 minutes of trading? Well, probably it's this mechanical close that's happening. So anyways, I trade on these signals that we get. Let's see what the next slide is. So this is kind of the run through of the time sequence of closing the New York Stock Exchange. And the reason that these guys put these big orders in is because look at the liquidity in the last 2 minutes of the New York Stock Exchange. 2.5% in the last minute is traded. So there's a huge amount of liquidity. They tend to get a fairly decent price on the stuff, and it's a great way of being able to move large amount of money in and out. So we'll just bring the meter up. So we have this meter that we built, which feeds us data. Like I said, at 2 o'clock we get some early data, and then at 3 o'clock things really start happening. And these are all Eastern times going into the close. And then on the meter we have, you'll see two things. You'll see dollar percentage and simple percentage. That is the amount of the dollars that are favored to the buy side. So here's 71% of the dollars are on the buy side of the balance. Remember, every stock's going to have an imbalance, or they don't necessarily, but if they have an imbalance, there's a whole list of them. We track about 300 stocks. On this particular day, there's 162 by the end of our period that are showing an imbalance. And of those 162, 71% of the dollar is on the buy side, and 58% of the symbols have buy imbalances as opposed to sell imbalances. And the difference of all the dollar value of the imbalances on this particular thing was 157. But like I said, hopefully you'll come and join us, and we'll do a webinar 1 week long, 1 month long, however long you want to do. I think if you guys are trading the last hour of the market, you need to understand how the market's closed. And that's not even if you're trading futures or you're trading stocks or you're trading options. That last hour is an important thing to understand. So we had this meter. So we used to sell it's just the meter by itself. And then, there'd be so many days I would get an email saying this thing didn't work. And I would have made 2 or 3 points going into the close. And it's like, I don't understand, because I have my trading rules. I trade and I publish my trades, and I end up positive, and I get a nasty email from someone that said it doesn't work, or I don't really know what I'm doing, those kinds of things. So we decided to build the meter into one of our rooms, and if you're an IM Pro member, you also get the meter as part of your package too, or you can buy the MIM just separately. So every day around 2 o'clock, I come into the room, we get the early look to see if there's going to be a trade set up, and then we talk about the trade. And for me to trade, it's got to be a really in-your-face number. I'm looking for, the fastball, or maybe a slow ball down the middle, meaty, and I'm gonna hit it. And we have a pretty good result based on that. And but you only get maybe 7 of those, maybe 8 a month. So sometimes it's just about being patient, waiting for the right trade to come, and then just swinging at it and taking whatever you get. Sometimes it's 2, sometimes it's 4, and we've had 10 and even 12-point trades going into the close. And our hit rate is above 66%, which is the magic number. If you guys have ever done any type of trading systems or anything, 66%, 2 to 1 is the kind of number that you need to have in order to be profitable. So that's that. Okay, so that's what I do in the IM Pro room, or in the MIM room, in part of our trade chat thing. It is $99 a month if you want to be part of that close every day, be able to set up the close every day. But because you guys are in here today, and it's hard for me to say this, because I promised I would never discount the MIM, because I think it's, to me, paying $99, even if you use it for a month and it doesn't meet your trading style or whatever, you build an inherent understanding of how the market closes, and the close means so much more to you than it did before. But anyway, so if you go onto that link, you'll get the first month for $24, and then it'll be $99 a month. You'll get access to our trading room, and you'll be part interactive. And then you can ask all the questions, and I'm a lot better one-on-one than I am talking to 450 people live. So that is that slide. Any questions before we go on? Because we got another thing going on too. So there's 2 ways to be involved with us coming out of this thing. Starting on March 9th and March 13th, we're going to have a boot camp. Okay, and that boot camp is what's going to be $7.95, $8 for a week of being in the boot camp. Now that boot camp for a week will give you all access to all the IM Pro. We have a new partnership with the Discovery Trading Group, who does market deltas. They're going to be part of that. You'll get Top Notch and WB, and who else you're going to get? You're going to get Stuart from Chicago Trading. You're going to get all those guys in the boot camp. So that's a whole week long of talking to Danny or me or any of our traders and seeing how we trade in our IM Pro room, and talk about that. And the MIM will be part of that week. So if you want that for $7.95, you can do that for a week. Or if you want the MIM for an entire month and go with us, and you really need to be on the MIM, you have to go through a month of the of the closing to kind of really get it. You can do the ride the min. Right. So why don't you come back on, Danny?
Okay, you guys. Great job, Marlon. All right, look. We charge $350 a month for our room. We know it's a high rate, okay? But this is an opportunity to, one, get the MIM, which is a great product. You can get it on your own, or you can join the room, and you be in there every day. You'll have the MIM, and you'll see Marlon making trades. Now, Marlon's not talking about these indicators that we also worked on. That there's a couple cool indicators. One that's set up off the VIX that actually gives you buy and sell levels for the MIM. But I think it's best that you just, really, you guys, this is a really rare opportunity. Not only will you get this stuff, you'll get me putting in flow all day long like I do for Marty. And you'll see exactly what Marty was talking about. And I'm going to tell you guys something. There is no way in hell that Marty would ever say anything about a product, because he doesn't do that. I didn't ask him to talk about market delta and me reading those charts the way I read them. And I think if he asks my guys, hey, is there anybody who's left from my room here? Do I not read that thing? You know, I can read that thing. And I think you guys can learn to read that too. You know, there's really three things here. One, there's the MIM. There's four things here. There's the MIM that you can get on your own for $99. There's the MIM room that you can join. Let's go back to that for $24, which is a measly amount of money. Or you could just join the main room and get all of it in one thing. I guess I would think it was four things I was thinking of, but you know what? I'm all crazy and mixed up here now. But you know what? At the end of the day, what this is about is expanding your trading toolbox. This is seeing what we see. This is seeing what we trade off of. And this is a proprietary tool. This is a really cool tool. You can, you know, it's going to show you right at 2. Actually, some of this data has now been showing up at 1 o'clock in the afternoon, 1 o'clock Central Time. You can start to see buys coming in. We're not posting it yet, but maybe Marlon will start to show a little bit of that. But I'm going to go back to this again. I'm going to say to you guys, do you really not think that the mutual funds know this? You know, the market, the S&P's weak all day long, right? And it looks like crap. But all of a sudden, after 2 o'clock Central Time, I'll say Central Time because that's when the S&Ps are trading, the S&P starts to short cover. And then all of a sudden, the MIM turns on, and it's showing 70 million to buy. And then the next reading, it's showing 125 million to buy. And all of a sudden, we're going out on the Twitter, we're saying MIM showing to buy. And what happens? You guys are from Twitter. Some of you guys see what goes on when we do this in Twitter. Hey, Heather M., how are you? Good to see you. But is there historical data offered with this? We can get historical data, but I'm going to tell you, historical data is extremely expensive. If you want, and I know what you're going with, LF, with this, and we've had other people that ask us about this, and we have helped get, connect people for the historical data. But I'll tell you, it's between $12,000 and $15,000 a month. So if you got, and I'm sure there's a lot of people in here that would have that kind of money to take that. In fact, one of the guys from UBS would like to get the data because he's got a company that writes algorithmic programs, and I think that's really what a lot of people want that data for, writing programs so they can trade the close. But anyways, I think it's been an exciting day. I think as traders, we spent a lot of time here. You guys too. 2 hours of your time on a Saturday. And I really, really hope that we made it worth it for you. You know what I mean? Bringing in the Pitbull. Pitbull sitting around answering questions. I mean, I think we can get him to come back. I think we can. And, at that stage, maybe what we do in advance is we get questions from you. And then we have it in front of us. And then we can have him just kind of read from the questions and talk. But he's an amazing, amazing man, you guys. And you know what? Someone said to me the other day, oh, you're just ass kissing. I'm going to tell you something. I don't ass kiss nobody, and I don't ass kiss the Pitbull either. We've gone at it for years. Before electronic trading on the trading floor, if you even listened to a phone call of us fighting on the phone, you'd fall off your chair. Okay, so what this is this is an accumulation of all the things that we've learned on the trading floor, all the things that we've learned off the trading floor. It's the Pitbull, WB, Discovery Trading, Rob from Discovery Trading joined. We got Top Notch. We got Shy Stock. We got so much going on in that room. If you're a trader and you want to be part of what I call flow, trading flow, you know, guys sit around, they're looking at, and I don't consider CNBC or Fox trading flow. I mean, if you think CNBC or Fox is trading flow, then you don't know what trading flow really is about. Because trading flow is everything. It's news. It's premium levels. It's algorithmic. It's volume. The list could go on forever. But you know what? How are you going to get that? Where are you going to go to be connected as other traders where you can get it plugged in all at once and have the eyes and the views of all these other traders and putting out levels and talking programs and, oh man, you know. So when I made MrTopStep, I teamed up with John Nigerian. John's a good guy. You know what? But he's a salesman. He's not a trader. His brother Pete's the trader. And after about a year of getting dicked around, I went up to John one day, and I think if you guys know about this, I said, John, what the hell am I doing all these videos for? You know? And then one of his guys came up to me and said, hey, Danny, you know what? John's going to sell his company and you know, for $1 billion, and you're going to be part of that. And you know what I did that day? I quit. Because you know what? I'm not listening to anybody telling me I'm going to be part of $1 billion deal. And then we had to go back and we had to restart this whole thing over. They took down our YouTube channel. They took our Twitter away. We went from being, you know, we went from having a complete company to having nothing in one day. And you know why I did that? Because John started selling over my videos. We're not out here to sell. I mean, look, yeah, we got to exist, but these kind of fees are minimal fees. $24, $19. We're not talking about hurting people. We're talking about helping people. And again, I'm going to explain this, and I'm going to close it out like this. I may not make you money, but I may save you from losing money. And that is just as good, because as the Pitbull said, his best trading day ever was getting out of a loser. Okay? It's about risk management. It's about getting in. It's about getting out. And you know what? I can't tell you how proud I am of what we've got going on at MrTopStep. Marlon Cobb. The guy is he's from NASA. He's taking companies public. I mean, here he is taking his time out to develop a MIM that can help you guys read the closes. You know, I mean, come on now. So look, I'm going to finish it out like that. If you guys want to stick around and talk a little bit about, you want me to rave a little bit more offline, I'm more than happy to do that. If you don't, the hell with it. You know, we spent an hour and a half, 2 hours doing this, and you know, I think we accomplished what we set out to do.